to what is your risk return metric like. Now, there's a lot of data in this slide, and there's a lot of charts here as well. How do you read this? So this is your ideal risk return curve. Now, how have we made this study here, this analysis here? So you can look at this here. We've taken 3 indices, the Sensex Total Return Index, the CRISIL 10-year Gilt Index, and gold in INR terms. And then we've converted this, and we've taken 1-year daily rolling returns and rolling standard deviations, which is what we're using for volatility matrices. And then we calculate portfolios, really 50 combinations of portfolios for debt and equity and gold, and we arrive at this risk return curve. Now, how do you read this curve? On the x-axis of this chart, you can see returns, and on the y-axis of this chart, you see risk. How do we calculate risk? Risk is nothing but volatility. Risk is nothing but your standard deviation. So, as a 100% equity investor, this is what your risk return metric is like. It shows somewhere around 22-23% of return, with risk, with volatility at around standard deviation at around 14-15% or so. This is where you are. Now, as an equity investor, your mindset always is to try to reduce your risk. And in the process of reducing your risk, you have to trade off some return for it. As a bond investor, what you're trying to do is you're trying to improve your return, and at the same time, you don't want your risk to go up by much. So 100% bond investor would lie here, and 100% equity investor would lie here. For a 100% equity investor who's here on the risk return curve, and 100% bond investor who's on this part of the curve, we have to understand that bond biased portfolios, they are adding equities to optimize on the return on the risk return curve, and equity biased portfolios, they add negatively correlated assets, which are debt and gold, to reduce their risk. So we have to arrive at somewhere in between. Let's take this spot, for example. This is around 25% equity and 75% debt. This is giving you that magic number of 12% CAGR from a market standpoint, which is somewhere around 7% on risk. Can we find the same 12% CAGR return for a lesser level of risk? The answer is yes. What do you need to do for that? Add gold to your portfolio. And when you add gold to your portfolio, this is another sweet spot that you get. You get 12% CAGR, but for much less risk. So you got 12% CAGR here with around 7% risk. Now you're getting the same 12% CAGR by adding gold. That is giving you somewhere close to 5% risk. Now, this is a theoretical case and completely unconstrained portfolio where you can have whatever ratios you want for equity, debt, and gold. So the sweet spot that we're talking about here is 10% equity, 45% debt, and 45% gold. In a real world where there are a lot of angles of tax arbitrage, a multi-asset portfolio has to also look at the tax angle there. So when you bring in the tax arbitrage component, for example, if you have a net 65% equity, you're considered as an equity fund, and your tax implications are very favorable, or rather very different. So when you look at in the practical world, you have to understand this is a theoretical contract construct that the data tells you. You have to add the tax arbitrage to it. And the key takeaway that you must have from this slide is diversification brings down your risk even for the same level of return. If you summarize all of this into 2 little charts, you can arrive at these charts here. The top one is on volatility. You can see an equity portfolio, the volatility, the maximum amount of volatility and the minimum amount of volatility from 2001 to 2024. That's what data tells us. You are reducing the volatility range by adding debt, reducing it even further by adding gold. You're looking at the range on returns. You have a very wide range in equity. You're adding debt, your returns come down, your range of returns come down and come down further with gold. But what is happening here is you're stabilizing your returns and trading it off with much lower risk. So equity plus debt plus gold, you're getting an average return of 14% for a much lower risk of 8%. And lastly, and the most important in times like these, the 4 most dangerous words, according to Sir John Templeton, when it comes to investing are, this time it's different. This is Arjun signing off. See you next time on E.M.I.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.